So once again welcome to second speaker CA Geetika Gupta ji for the second technical session, and that is on the topic a special technical issue relating to dividend interest royalty and FTS. So before inviting her for second technical session, I request moderator of the second session, Deepali Garg, to brief about her.
Yeah, good evening, everyone. Welcome to Geetika ma'am as a speaker and Sumit sir as a founder of CASA. So I will give the brief about the Geetika ma'am. Geetika ma'am is the by profession chartered accountant. He is a very vast experience in the field of the direct taxation. Now she is working in the PwC as an associated partner. She have a very wide experience in the. She is advising. She is a speaker in the various conferences, forum, and chapters of the ICAI. She is a she is advised very number of companies as a Indian companies and multinational companies on the various tax matters. She has a very wide experience in the taxation as a tax litigation, compliances matters and advisory. And she is a member of the International Taxation Committee of ICAI in immediately preceding years. And now we will discuss today this second session on the matter technical issues related to the royalty, technical fees, and dividend. And so Gitika ma'am will explain what will be the compliances for the payment of the royalty and technical services, etc. And other tax litigations. So she will explain and what will the compliances on these matters and will be the what will be the documentation compliances, etc. So can we start, Gitika ma'am, this meeting?
Yes, ma'am.
Sure,
Over to Geetika ma'am.
sure. Thank you. Thank you so much, Dipali ji, Sumit ji, Sachin ji, for giving this opportunity today. And thanks, Parul, for agreeing to stay. Really had been a pleasure to hear her. I was there for a few last minutes, but it was really connected session and great to hear her. So we'll start for today's sessions. First of all, wish everyone a very happy new year. नव वर्ष की आप सबको बहुत शुभकामनाएं. And this international tax series, today we will be talking about the technical issues relating to dividend, interest, royalty, and fee for technical services. The said topic assumes greater significance in the times of today when we are in the age of digitalization where software is dominating. The new business models are coming up, and it becomes very important to ascertain the income which is being derived by non residents from the Indian customers, whether they can be brought within the ambit of taxation. So how we'll start is we'll cover in the agenda like introduction. Some slides Parul has already covered in this. So we will touch upon it very briefly, like the taxation about a foreign company. Then we will move to dividends, interest, royalties, FTS, and we'll try to have some case studies running side by side. Okay. So first is taxability of foreign company uh, in India. That is where a foreign company earns income from India. How that is to be taxed. So under the domestic tax law provisions, as was discussed in the previous session, the scope of total income includes whether the income is received in India or deemed to be received in India, or if it is accrued or arise in India or deemed to accrue or arise in India, then in such cases, the non-resident would be liable to tax in India. Now, received, deemed to received is pretty simple. What is actually received in India, that will of course be taxable. As far as accrue or arise is concerned, these terms are not defined under the provisions of the Act, but they indicate a right to receive. So, from various judicial precedents, the terminology for accrues and arise becomes clear. That is, they represent a stage anterior to the point of time when the income becomes receivable, and it connotes the character of income. Then the Act also provides for certain situations where the income is deemed to accrue or arise in India. And under the provisions of Act, any income which accrues or arises from any business connection in India, or from any property situated in India, or through a source of income in India, from the transfer of a capital asset situated in India, shall be deemed to accrue or arise in India. And again, in case of a business of which all operations are not undertaken in India, the income of the business deemed to be accruing or arising shall be only so much part of the income which is attributable to the operations carried out in India. And this part was also covered in the earlier session by Paro. Now, the Act also provides that royalties, fee for technical services, which is paid by a resident to a non resident, except in certain circumstances, that is, where it is in respect of business or profession carried out India, it is deemed to accrue or arise in India. So it is very important to note here that royalties, FTS, they are specific streams of income which are liable to tax in India under the deeming fiction, regardless of whether the performance of the income generating activity has been carried out in India or out of India. Now, this is about the domestic tax law, what we call the Income Tax Act provisions. The Act also provides that the non residents shall be given a benefit of the tax treaties where it has been entered into. So, the central government of India has entered into agreements with government of various countries to grant relief of tax, to avoid double taxation, for exchange of information, and such agreements being referred to as tax treaties or DTA. So the Act provides an option has been granted to the non residents to be governed by the provisions of the Act or treaty, whichever is beneficial. Now, a very important question which arises here is foreign company whether it can take recourse to the beneficial provisions of tax treaty. Obviously, the answer is yes, but it is very important that the foreign company should be eligible for the tax treaty benefits. It's not like any foreign company says, okay, the rate provided in the treaty is lower. Let's say the tax rate for dividends is 5%, and under the domestic tax law, it's 20%. And it says, okay, I will avail the treaty benefits. That company will have to satisfy the criteria that it can avail the treaty benefits. And these conditions we'll discuss. So, what it provides is the person should qualify as a resident of a country. So, what it says, resident means any person who, under the tax laws of that state, is liable to tax therein by reason of his domicile, residence, place of management, or any other criteria of a similar nature. This is a very important condition. When we see any treaty, the opening lines of the treaty says the person should be a resident of one or more of the contracting states. So residency is very important. The second is to obtain tax residency certificate, commonly referred to as TRC, issued by the tax authorities to avail treaty benefits. Now, generally, a lot of questions come across that if it is a TRC, the person, let's say a foreign company based out of Netherlands, has obtained a TRC from the said revenue authorities of Netherlands. Is it sufficient to claim the treaty benefit, or there is something more which the foreign company needs to do? So the answer is TRC, yes, it's a very, very important document to claim treaty benefits. But in the times of today, there are other things also which needs to be satisfied, like the beneficial ownership concept, the principal purpose test, etc. So this principal purpose test, just touching very briefly under the multilateral conventions, what it provides is that if a person has entered into a tax treaty just to avail the benefits, so exactly what it provides it, that PPT, under PPT, a benefit shall not be granted if it is reasonable to conclude that obtaining tax benefit was one of the principal purposes of any arrangement or transaction that resulted in that benefit. So, sometimes in these multinationals, they try to play around. Like if there is, let's say, a US based company, it makes an investment through a Mauritius or a Singapore company just because a Singapore or a Mauritius company provides a lower tax rate. So Mauritius company would be earning that income. The question arises whether lower rate of dividends or let's say interest income, royalty, FTS, etc. So whether that discounted rate be given. So the answer is even though there may be a TRC, but the additional things like principal purpose test is very, very important. That what was the objective of incorporation of that company? Was it merely to achieve a treaty benefit or it is all for business and commercial reasons? The next is beneficial owner. This we shall be discussing in the ensuing slides in later detail also, because it's very important for these passive streams of income like dividend, interest, royalty, FTS. The person who earns the income is the beneficial owner of the income. It is not that just I'm receiving the income on behalf of someone and I am just an intermediary interposed to receive this income, and we'll discuss about this anti-abuse measure in greater detail. Okay. So this slide presents an overview on how to tax these incomes in case of P, no P. So the Act prescribes a methodology for computing income under dividends, interest, royalty, FTS. The same would vary depending on whether the non-resident has PE, which is permanent establishment, or a fixed place of business or not. So let's say the situation one, which is on the left hand side of the slide, is that there is no P or no fixed place of business of the foreign entity. The Act, under the provisions of Section 115A, provides that the income shall be taxable on a gross basis. No deductions shall be allowed for the expenditure incurred. And when we come to taxation of like royalty and FTS on a gross basis, under the Act, then it will be a 20% tax rate plus applicable surcharge and cess. And it is very important to note here the earlier, before this previous financial year, the rate was 10%. Now the rate has increased to 20%. So it's a almost double the rate under the domestic tax law provisions, whereas the treaty provides normally for a lower tax rate. So more and more companies, non-residents, they would like to avail the treaty benefits, and hence more significance of getting that treaty benefit. Now, similar to treatment, what has been provided under the Act in Section 115A, similarly under the DTA also, it is provided that royalty, FTS, which is not attributable to the PE, would be taxable on a gross basis. And the articles which generally deal with these type of passive income is Article 10, 11, 12, 13, etc. And the rate ranges between 5 to 20%. Now, on the right hand side of the slide is a situation where the income is attributable to a PE in case of a non resident. In such a scenario, the income would be taxable on a net basis as per treaty, Article 5, read with Article 7. So, just like as for the Indian domestic companies, it's a proper profit and loss account maintained, revenue, expenses, deductions, net profit. So, similarly, the all the compliances needs to be done, the account needs to be audited, etc. And the income needs to be offered on a net income basis. Whereas when we talk about gross basis, there is no accounts etc which needs to be audited. So if let's say the foreign company has earned income from India, let's say from 5 customers, so the backup documentation is like the invoices, the underlying agreement, etc., and that is offered to tax on a gross basis. Let's say the foreign company has rendered technical services to an Indian customer, so that will be taxable on a gross basis. Let's say it is India Netherlands treaty at a rate of 10%. And obviously, the Indian company would also have to undertake compliances if the income is chargeable to tax. So, though it's not on the slide, but I'll just briefly touch upon here from the perspective of Indian company when it is making payment to a non-resident, and if the income is chargeable to tax, the Indian person would have to withhold taxes. Failure to withhold taxes leads to separate consequences, which could be disallowance of expenditure in the hands of ICO, which could be separate TDS proceedings, penalty proceedings for failure to withhold tax. But the law states that when does this situation arise to withhold tax? It is only if the payment made to the non-resident is chargeable to tax. If the payments are not chargeable to tax, then there will not be requirement to withhold taxes. So this is a brief overview on the taxation of the foreign companies. Now we will move to the specific topics. The first one being dividend. Now, dividend, as you know, we would have heard a lot about in the past, dividend distribution tax, etc. But now that's all abolished. Now it's the classical system of taxation where dividends are taxed in the hands of the investor. So, up to assessment year 2021, if a shareholder used to get dividend from a domestic company, then the shareholder was not liable to pay any tax. The income was specifically exempt under Section 1034 of the Act. However, the domestic company, which was declaring the dividend, was to pay a dividend distribution tax. Now, this has been abolished, DDT, and it's the classical system of taxation, that is, dividends are taxable in the hands of the shareholders. So we will just briefly touch upon what does the term dividend refers to, which is distribution of profits by a company to its shareholders, and the domestic tax law provisions also deem certain items to be included as dividend, what we normally term as deemed dividend. There are five specific instances. The first is distribution of accumulated profits to shareholders, entailing release of the company's assets. Then is distribution of debentures or deposit certificate to the shareholders out of accumulated profits, issue of bonus shares to the preference shareholders out of accumulated profits, distribution made to the shareholders of the company on its liquidation out of accumulated profits. Similarly, on the reduction of capital by the company also, it leads to deemed dividend. And the fifth one is loan or advance made by a closely held company out of accumulated profits to a shareholder, or if there is a loan between two sister concerns and there is a common parent shareholder or a specified percentage of shareholding, that also invites deemed dividend implications. And these are very practically used, you know. We often see there are loan transactions between two fellow subsidiaries, or a company giving a loan to a shareholder, or the company is going into liquidation, the Indian company, and the company is distributing certain assets, cash to its shareholders. So practically we see it entails deemed dividend implications, and if that be so, then the shareholder will have to pay taxes on the same. Let us understand this with the help of a case study. Okay, before the case study, we will also cover this dividends under the DTA, and then we will move to the case study. So, dividends is chargeable to tax in the source country as well as the country of the residence. Let's say there's a Netherlands company. It has invested into the shares of an Indian company. So, the dividends earned from India will be taxable in the source country, that's India. It may also be taxable in the country of residence, that is Netherlands. So, generally, the country of residence provides a credit of the taxes which has been paid in the source country, because there should not be any dual taxation. Now, when it is taxable in India, the Act provides that the same can be taxed under the provisions of the domestic tax law or the treaty provisions, whichever is beneficial. Like dividend under the domestic tax law is 20%, whereas, say, under the Netherlands treaty, it is 10%. So, obviously, the non resident would like to avail the benefits of the treaty and apply that 10% rate. And in most of the DTAs, dividend taxable in the source country, say here India, in the hands of the beneficial owner ranges from 5 to 15%. And this beneficial ownership concept is very, very important. Practically, we see that the tax authorities test this beneficial ownership condition to grant treaty benefits. The table below is what we talked about the rates that the assessee is a foreign company, 20% taxability under 115A. Third column says tax treaty, depending upon which country the non resident is from, the rate will depend. There are specific articles in the treaty. Normally, generally, Article 10 talks about this and it will prescribe a rate also of the dividend. And then withholding tax has to be as per the domestic tax law or treaty, whichever is beneficial, and no deductions are allowed. The next is resident that we can leave. That's obviously dividend received by a resident will be at the normal tax rates. So now we'll understand this with the help of a case study, deemed dividend concept. So let's say there's a foreign company which is a resident of US, and foreign company holds 100% shares of the ICO. Now, ICO grants a loan of INR 1 lakh to its shareholder FCO. Question arises whether this loan transaction is taxable, in whose hands? Yes, this transaction is taxable provided that ICO has accumulated profit. So, whatever is the loan granted by ICO to the extent of accumulated profits will be taxable as dividend in the hands of the shareholder. And that will be taxed again as per act or treaty, whichever is beneficial. It's US, so it's a 15% rate under the tax treaty as compared to 20% tax under the domestic tax law. So hope this is okay. We move to the next case study. Okay. So the next case study is there's a foreign company who holds 100% shares in ICO as well as 100% shares in ICO 2. So ICO 2 grants loan of 1 lakh rupees to its fellow subsidiary ICO 1. The question arises, this loan transaction between the Indian subsidiaries, whether it is deemed dividend, in whose hands? ICO, ICO 2, or shareholder? So the answer is the dividends will be taxable in the hands of the shareholder, that's the FCO, to the extent of the accumulated profits of ICO 2. And again, the rate will be 15% in this case, assuming a beneficial rate under the treaty. And these transactions, practically, these are used. We have seen practically it creates a lot of importance. Sometimes we see there are two Indian companies, the funds are needed, and the loan is just given between the companies. So it's very important to, identify, highlight that what could be the dividend implications in such a case. Okay, and then we will move to the next case study, which is again in context of dividends. And this also captures, like when one of the domestic companies receives the dividend, let's say from an Indian company, and that Indian company further distributes the dividend to its shareholders. So it's the question why this case study is there is whether there is going to be a double taxation, that ICO, which has received dividends, first it will pay tax, and then when ICO further distributes the dividend to its shareholder, the shareholder would also be liable to tax. So in this case, there is a specific section 80M of the Act which provides for the removal of cascading effect of dividend. So I'll first discuss the case study here, explain the facts. There is a foreign company, US company. It holds 100% shares in ICO 1, which is an Indian company. ICO 1, an Indian company, further holds shares in another ICO, an Indian company. Now, ICO distributes dividends to its shareholder, ICO 1, let's say 1 lakh rupees. ICO 1 distributes the dividends to its shareholder, FCO of INR 80,000 rupees. The question arises then how the working needs to be done. Now, in the hands of ICO, there is no tax implication as there is no income. In the hands of ICO, first, the dividends receipt is 1 lakh rupees, but assume that out of this 1 lakh, 80,000 rupees have been further distributed as dividend to its shareholder in the same financial year. Then ICO 1 will get a deduction of 80,000 rupees and the taxable dividend in the hands of ICO will be 20,000 rupees. Now, when we go to this foreign company, this will be taxable at the rate of whatever rate is provided in the treaty. Let's say US 15% on 80,000 rupees. So the important part here is what the box says, ATM, domestic company receiving dividend income from another domestic company. Such dividend is included in the gross total income of the Indian company, and the deduction is limited to the amount of dividend distributed by the dividend receiving company. And the condition is that dividend is to be distributed maximum up to 1 month prior to furnishing of return under section 139. So it should not be a case like, say, in year one, the company earns dividend, but after 3 years, the dividend is further distributed. Then there will be no such deductions. Then the dividend income will be taxable in the hands of ICO 1 as well as in the hands of FCO. But if the dividends are distributed within the timelines, that is up to 1 month prior to the furnishing of return, let's say 30th November is the return, and even up to 31st October this is done, then the deduction would be eligible. Now, again, from a practical perspective, from a compliance perspective, what is important here is like, when the non resident is taking the treaty rate, the question arises whether it has to file a return of income in India. The answer is yes, because you know there is no exemption under the act. Had there been any exemption under the act and the TDS is deducted at the rates provided under the act, then a person can avail that benefit of not filing a treaty. But when a person, a non-resident, a foreign company is earning certain incomes, dividend, FTS, and the same is being offered to tax at a beneficial rate, then the non-resident will have to file a return of income. It will have to obtain a PAN, obviously, to file a return of income. It will have to obtain tax residency certificate. If the tax residency certificate does not incorporate all the items mentioned in that, because the section 90 says that specific items needs to be included in TRC, like the name, your registration number, PAN number, etc. If all these details are not there, then the person will have to file Form 10F also, no P declaration. I think there's one question in the chat where it is written that they have to file ITR. Okay. Um, so, in filing of the return of income, what the Act prescribes is there are certain specific exemptions. And the exemption provided is only when the tax is deducted under the provisions of the Act and the only income is dividend income, etc. Then there may not be any requirement to file the return. And section 139 says that all the incomes, all the companies are required to file the return. And this exemption is stated in section 11A, subsection 5 of the Act. Otherwise, there is no exemption. Normally, practically we have seen many companies says why to file the return. See, if the tax is deducted at 20 plus surcharge, then fine, no need to file the return. But if the foreign company says, no, why do I pay extra taxes? Even if withholding is done at a higher rate, let's say 20, I'll file a return to claim refund of those taxes. Even in that scenario, to claim refund, it's important to file the return. And another question relating to this is ICO will deduct TDS at 15%. So the answer is yes. If the treaty provides for a rate of 15 or for a rate of 10, then the tax can be deducted at that rate. What the payer will have to do is ask for a TRC, ask for a no P declaration from the non-resident, and then deduct tax as per the provisions, whichever is beneficial. And this has also been clarified in a couple of apex court judgments like GE Technology. And recently, also in 2021, in the case of engineering analysis, the judgment on software, which we will be covering in the subsequent slide, that also clarifies that both the provisions, the TDS and chargeability under section, this 195, they are integrated provisions. So if the payment is taxable at a reduced rate under the treaty, that can be done by the pair. Okay. So we will move to the next slide. Yes, beneficial ownership, which is a very, very important concept. Um, and these days, practically it is being tested. Now, this condition of BO has been introduced in the DTAs as an anti avoidance measure to ensure that DTA benefits are not granted to recipients who act as bare nominees of the income and they claim favorable benefits by resorting to tax treaty shopping. The term BO, it has not been defined in the DTA. However, it is applied to draw a distinction between legal ownership and economic ownership in the circumstances where the legal owner is not the economic owner. Let's say the are in my name. Now I say I received that dividend income. So I should be entitled to this treaty rate. But that income actually doesn't belong to me. I have to pass on that income to my parent company. मेरे ऊपर there is a specific mandate कि as soon as I receive this income मुझे ये पास कर देनी है अपने parent company को. तो right to enjoy that income is only of my parent company. मुझे तो बीच में सिर्फ इसलिए इंटरपोज किया गया था कि ट्रीटी का बेनिफिट लिया जाए. That is the objective of introducing this BO concept. So, to qualify as a BO, the recipient not be a nominee, not be an agent or conduit. It should be able to decide on use of the income in its own right. Supposing I am Mauritius company, I receive dividend, I am entitled say at 5%. I should have the right. I may pass it on to my shareholder, but it is my decision. My board should take a decision कि ठीक है मैंने उसको सब अपने इधर इन्वेस्ट कर लिया या जो अपने एक्सपेंसेस करने थे कर लिए. Now I have an extra income and now I decide कि I will pass this on to my shareholder. That's fine. But it should not be income I वहां से मुझे the agreements are there कि I need to pass on the income. That's a problematic situation. So the direct recipient is not the BO if the recipient's right to use and enjoy dividend is constrained by contractual or legal obligation to pass on the payments received to another person. So, the various bullets on the slide bases the international tax commentaries and judicial precedents. They lay down certain parameters how it will help in determining the BO, which is practically very, very important, when the client assignments are done. Like the recipients has the right to enjoy the income without any contractual obligation to pass the same to any other person. Utilization of the income is at discretion of recipient. The recipient is not collecting as an collection agent of another person कि सिर्फ ट्रीटी का बेनिफिट लेना है तो आप मेरे बिहाफ पे कलेक्ट करके मुझे दे देना. ऐसा नहीं होना चाहिए. Recipient receive dividend in its own bank account. It should not be a case my bank account is controlled by my parent only. That's a problematic situation. Investment by the investor in its own name. I invested the money in the Indian company as a Mauritius company through the proper banking channels, which is a positive fact to prove BO. There is place of board meetings where decisions related to operations taken. Like I am a Mauritius company, I have my own board of directors, etc., which takes decisions, which decides on various functions. So I'm not a conduit and the directors are qualified for taking investment decisions. The terms and conditions of the shareholder agreement are clear. The recipient company has employees, space. This is all to prove more substance in the company. So this is very, very important BO concept, which is used for all passive income streams. So with this, we will move to the next topic of interest. Okay. So interest taxability is also like dividends on a gross basis with no deductions under the treaty. Now there is a definition of interest under the act also, under the treaty also. So left hand side is the act, right is the treaty. And then there's a typo act, it is a treaty. So left hand side says it means interest payable in respect of monies borrowed or debt incurred, and it includes any service fee or other charge in respect of monies borrowed or debt incurred. Under the treaty, also, the definition says that interest income can be from debt claims of every kind. And again, like dividends, it's chargeable to tax in the source country as well as the country of residence. And the country of residence generally provides for credit of taxes paid in the source country. Similar to dividends, it could be rate under the domestic tax law 20% or under the treaty, whichever is beneficial, and the person needs to be beneficial owner of the income. Now, this foreign company under the domestic tax law, section 115A, the rate is 20% plus such cess. Under the treaty, it could be 0% depending on treaty to treaty, could be 10, could be 15%. The rates under the treaty will not be subject to a separate surcharge or cess, as the case in this case of Act, it is applicable. And again, for the withholding tax purposes, act or treaty, whichever is beneficial, as we discussed under the dividend provisions. So, moving to the next under interest, there's a concept of thin capitalization. So, just I'll briefly discuss that. See, many multinational companies typically finance their subsidiaries through debt and equity. हमने देखा है नॉर्मली कंपनीज में ऐसा नहीं है सिर्फ इक्विटी फंडिंग होती है बहुत बार मिक्स होता है देयर इज अ डेट देयर इज अ इक्विटी एंड there are benefits to do that also. It's a healthy mix of debt and equity. And a company which is financed through a relatively high level of debt as compared to equity is known as thin cap. So earlier this concept was not there under the Indian tax law. It was only in case of the foreign jurisdictions, but now it is there in the income tax. अगर आपकी कंपनी में बहुत ज्यादा डेट है, then it is called a thin capitalized company. And this is considered as a tax friendly mechanism, and it is adopted by many of the taxpayers because there is an interest deduction. Dividend is not a tax deductible expenditure, whereas interest is. So, if the deduction is taken out of the profits, out of the income of this interest, then obviously the taxable profits will reduce. So, what this thin cap provisions provide is that in respect of the interest expense, which is paid by an entity to its related party, to its then associated enterprise, the interest deduction shall be restricted to 30% of its earnings before interest, tax, and depreciation, or interest payable, whichever is less. Let's understand with the help of a case study. This is a foreign company. It has granted ECB, external commercial borrowings, to its wholly owned subsidiary in India. Let's say for 20 crores rupees, let's say it's 10% interest, which the ICO has to pay to FCO. So in this example, you will see on the right hand side that there's an interest expenditure of 2 crore rupees. Let's say the EBITDA of the ICO is 25 crore rupees. So 30% of EBITDA is 775 lakh rupees. And so the interest in excess of 30% of EBITDA, that is interest was 20 minus 750, this 12,500,000, this will not be eligible for deduction. It will be carried forward. So the interest deduction in these cases is not unlimited. The law provides that interest will be limited to 30% of EBITDA, and whatever is not eligible for deduction can be carried forward up to 8 years period. So this is the deductibility of expense in the hands of ICO. Now in the hands of FCO, this interest income of 2 crores will be taxable at 20% under the Act and 15% under the DTA US. Beneficial rate 15% that can be taken off, and the compliances will again need to be done by the FCO, like obtaining a PAN, filing a return of income, 10F, no P, as we discussed in the case of dividends. So moving on to the next slide. Okay, so again, this is a practical thing. We see that interest on income tax refund derived by the foreign companies. So when the income tax department is paying this interest on income tax refund, we see that a 40% plus surcharge and cess taxes deducted while paying these interest on income tax refund. So the foreign company, by filing the return of income, it can claim refund of the balance amount because it will be liable to tax in respect of this interest as per the treaty provision. Let's say it's 10 or 15%. Then 10% is the taxable income. 40% the taxes which have been deducted will be claimed as a refund against the tax liability. 30% can be claimed as a refund. And in this regard, there are judgments also. One of the judgments of the Madras High Court, wherein it has been held that refund payable to the assessee by the revenue is in the nature of a debt claim, and the interest income on income tax refund be offered to tax at the beneficial rate provided under the treaty. Okay. So with this, we will move on to royalty and FTS. Royalty, we will focus on the software payments because that is much talked about. And in FTS, a lot of practical things are there, which we'll try to cover here. So again, as we discussed, these royalty income, it is taxed as per the deemed source rule. What basically it provides is that any income by way of royalty, which is payable by a government, or it is paid by a resident person to a non-resident person, except where it is paid in respect of a business carried out outside India, or where it is paid by a non-resident to a non-resident person, what we normally called as the double source rule. It will also be taxable in India, where it is in respect of a right, property, or information or services used for a business carried out in India. So we will discuss in the next slide what is royalty. Yeah. So see, royalty generally, as we all understand, it's payment made to the owners of certain type of rights by those who are permitted by the owners to exercise the right. Now, under the Income Tax Act, royalty is defined to mean consideration for the transfer of all rights or any rights, or the use of copyrights, including granting of a license, literary, artistic, scientific work, etc. DTS defined royalty to mean consideration for the use or right to use any copyright, etc. Now, the question arises, see, if it's a simple use of a brand name of a foreign company, and the Indian, let's say, company is using a brand name, making payment for that. Yes, it's a royalty payment. So, a lot of controversy which arose in this regard was specifically pertaining to software payments. The 2 decades old litigation, which we'll be talking in the next slide, that why there was so much controversy and why a need about all these judgments. So, one important thing is to characterize a payment as royalty. One of the important conditions is recipient must be the owner or the license holder of the underlying asset in connection with which royalty is received. It should not be a transaction of an outright sale. Again, this Finance Act 2012, when there was much talked about insertion of the explanations 4, 5, 6 to section 9, which was like retrospective amendments made, huge implications. The controversy arose, okay, now the software payments all will be taxable. So, with retrospective effect, that was the main reason the matter went to, Supreme Court also for discussing this, which we will be talking in the next slide in greater detail. So this is again, we already discussed the royalty definition under the treaties. So here we start the concept of software royalty. See, taxation of income from computer software programs in the international taxation has been a contentious issue since many, many years. The debate principally focused whether these transactions will be characterized as royalty or say. Let's take एक फॉरेन कंपनी है, उसने इंडिया को कोई सॉफ्टवेयर, इंडियन कस्टमर्स को सॉफ्टवेयर दे दिया, आप यूज करिए ये सॉफ्टवेयर. तो कंट्रोवर्सी थी, अब जो मैंने सॉफ्टवेयर यूज किया है एज एन इंडियन कस्टमर, इज दिस अ रॉयल्टी पेमेंट or it's, just like purchase of a book. It's purchase of a copyrighted article. सॉफ्टवेयर बनाने में तो आपके कॉपीराइट्स यूज हुए, बट फॉर व्हाट आई हैव मेड द पेमेंट, इज इट कॉपीराइट or it is copyrighted article? If it is copyright, then it's royalty. If it's copyrighted article, then it's not royalty. So the slide which is presenting, we will discuss each and every scenario wherein the Supreme Court discuss these models, but just again giving a little more background. The tax authorities have generally taken a position: income from transactions involving grant of software is taxable as royalty, irrespective what are the rights of the end user. Whereas the end user says these payments are not taxable as royalty. I am not getting any rights to commercially exploit the software. I have not got copyright. आज मुझे अगर एक सॉफ्टवेयर मिल गया तो ठीक है ना, आई एम जस्ट यूजिंग इट. एक मेरे को बुक मिली, मैंने बुक पढ़ ली, दैट्स ओके. अब मेरे पास कोई राइट्स नहीं है कि आई स्टार्ट पब्लिशिंग द बुक. If I do that, or if I have the right to make copies of the software, commercially exploit it, then the issue will of royalty will come. तो टैक्स अथॉरिटीज कहती थी जी ये तो आपकी रॉयल्टी है, टैक्स पेयर्स कहते थे ये तो रॉयल्टी नहीं है. And there were various judgments. Karnataka High Court, there were negative judgment. There were a couple of favorable judgments, including the Delhi High Court in case of Infrasoft, etc. And considering these divergent views of the judicial authorities spanning over 2 decades, the cases traveled to the Supreme Court. Now, what facts were discussed and why this case law is very important and it's practically used, in day-to-day instances is, see, the Supreme Court examined 4 business models. So the category 1 is resident Indian buyers or end users of the software who purchases the same directly from non-resident supplier. आपने एक सॉफ्टवेयर खरीदा डायरेक्ट, जो अभी हमने एग्जांपल की बात की, क्या वो टैक्सेबल होगा एज अ रॉयल्टी? सेकंड एग्जांपल वाज रेजिडेंट इंडियन ट्रेडर. आप देखेंगे इसमें फर्क क्या है बिटवीन द फर्स्ट एंड द सेकंड इज, सेकंड में एंड यूजर को एक रीसेलर बेच रहा है, तो नॉन रेजिडेंट ने सप्लाई किया इंडियन रीसेलर को, और इंडियन रीसेलर ने आगे आपके मेरे जैसे एंड यूजर्स को सेल किया सॉफ्टवेयर. थर्ड सिनेरियो इज नॉन रेजिडेंट सेलर है, नॉन रेजिडेंट सेलर ऑफ द सॉफ्टवेयर ने एक और रीसेलर को, नॉन रेजिडेंट को सेल किया, एंड दैट नॉन रेजिडेंट रीसेलर देन सप्लाइज टू द इंडियन कस्टमर. एंड द फोर्थ सिनेरियो इज नॉन रेजिडेंट सप्लायर हु एफिक्सेस द कंप्यूटर सॉफ्टवेयर ऑनटू द हार्डवेयर. अब आपका हार्डवेयर भी है, उसमें एम्बेड कर दिया सॉफ्टवेयर, एंड टोटल सॉफ्टवेयर एंड हार्डवेयर एज एन इंटीग्रेटेड इक्विपमेंट बेचा to the individual customers. So question was whether it will lead to the royalty payments. And see, the important part is what's written in the box also below is the Supreme Court had looked into the end user license agreements in all these cases. So it becomes very important that when we see our cases, always in the licensing transaction of software, there will be EULA. And we see in EULA, there are, conditions stated like the distributor or the end user will only have a limited right, a non-exclusive right, a non-transferable right to resell computer. It is stated no copyright is transferred in these, either to the distributor or to the end user. No right has been granted to sub-license or transfer. There is no right to reverse engineer, modify any source code, etc. And what is paid for, the Supreme Court held this, what is paid for by way of consideration by the distributor in India to the non-resident is a price of the computer program as goods. अगर मैंने कुछ गुड्स, मैंने एक मशीनरी खरीदी नॉन रेजिडेंट से, मैंने एक बुक खरीदी है, वो टैक्सेबल नहीं होती बिकॉज द टाइटल इज ट्रांसफर्ड आउटसाइड इंडिया. Similarly, in case of software transaction also, the title is transferred outside India. It is akin to the purchase of goods and not taxable. Next slide, please. Yeah. So here, in this case law, a lot of important principles have been laid down. In this slide, what we will talk is about the important principles on the copyright versus copyrighted article we talked about. Supreme Court says parting with any right in the copyright triggers royalty taxation. Whereas when it's a simpliciter sale of a copyrighted article, it will not lead to, you know, royalty payments as being taxed. Then copyright, as explained by the Supreme Court, says what is copyright? It's an exclusive right, negative in nature, that restricts other from doing certain acts. भाई आपने सॉफ्टवेयर बनाया नॉन रेजिडेंट ने, आपको तो बनाना आता है. अब मैं यूज तो कर रही हूँ वो, बट मुझे बनाना नहीं आता सॉफ्टवेयर. आई डोंट नो व्हाट इज द टेक्नोलॉजी बिहाइंड इट. आई कैन नॉट सेल इट फर्दर, डू अ कमर्शियल एक्सप्लॉयटेशन ऑफ दैट. Then it says license from a copyright owner with no right of commercial exploitation is not a copyright, it's only a copyrighted article. The restrictive covenant, like non exclusive, non transferable, no sublicense, indicates use of a copyrighted product. Potentially, there is no copyright infringement for making backup copies. तो ये क्वेश्चन उठा, बहुत बार होता है. कंपनीज कहती हैं हमें एक बैकअप कॉपी चाहिए जब हम इतना कॉस्टली सॉफ्टवेयर खरीद रहे हैं. तो सुप्रीम कोर्ट सेज यस, बैकअप कॉपीज फॉर टेम्पररी पर्पस इज अगेन नॉट लीडिंग टू, deriving it in the nature of royalty and taxable. And in the absence of a copyright granted to user, the transaction is not taxable as royalty. Again, with this, while the Supreme Court had dealt with the issue of this copyright versus copyrighted article, various other parameters were also discussed by the Supreme Court, as we talked, when it's a withholding to be done by the payer in respect of this transaction also. So whether the payer should withhold tax, the principle we talked about just now under section 195, that if the income is chargeable to tax, if it's taxable, then you withhold. Like if in this case, the software is not taxable as royalty, then one may take a position that it's not subjected to withholding tax also. Various other important things, Supreme Court laid down, like what is the importance of the international tax commentaries in reading the judgments, etc. And also, this is a judgment which is practically used in many, many cases. And the principle also, Supreme Court said, when even under the domestic tax laws, like it's an expansion of the definition, but under the treaty provisions, because the assessee will be eligible, has an option to avail whichever is beneficial. So if the treaty provisions are beneficial, obviously the assessee will claim that not being taxable. So we'll move to the next slide. We'll discuss some important judgments, one or two judgments here, um, where it has been held on the facts of the case, why it not be construed as a royalty payment. So first was an online access to material available in database. So in this case, assessee is a resident of US. The business of the assessee, it collates data relating to healthcare available in public domain, and it creates a database by putting it at one place. Now it is giving access of these database to the Indian companies who are paying to the non-resident. Now it is clear from the agreement that customers are only granted the access to contents. They are not permitted to copy, to print, to reproduce, modify, translate the data. All right, title and interest in the licensed product, including copyright and other IPRs, is of the US companies and not of the Indian company. Basis these facts, it was held that by the Delhi tribunal that these payments are not taxable as royalty payments. In another case, which is the second column here on the web hosting, a non-resident earned income for providing web hosting services, which including providing data backup, maintenance, security. Tribunal observed that assessee was providing web hosting services with the help of scientific equipment which enabled rendition of such a service, and such a use which was not even by the Indian entity. Held that even though the services rendered by US company involved scientific equipment, the recipients cannot be treated as paying consideration for the use of scientific equipment. See, a very simple example. आप बस में बैठ के जा रहे हैं, आप कार में बैठ के जा रहे हैं, ट्रेन में जा रहे हैं, एयरप्लेन में जा रहे हैं. Whether scientific equipment is there, yes, lot of technology is there. But what I am doing, am I availing the service of a car, or I am availing the service of that scientific equipment? सो आई एम अवेलिंग द सर्विस ऑफ द कार. उसमें आप कोई कहीं नहीं नहीं, वो ना उसमें साइंटिफिक टेक्नोलॉजी लगी थी कार में, तो इसलिए ये तो रॉयल्टी पेमेंट हो गई। तो ऐसा नहीं है। दैट इज वेयर in this judgment also it has been held, the person who's providing the service may use softwares, technology, and equipment may be involved, but the person who's availing the service, if the person is given control of that equipment, supposing of the service is used, then it is a separate thing and may tantamount to royalty. But if it's simply I'm availing a service, then it should not be taxable as a royalty payment. Similarly, another judgment in context of data processing support, which says assessee is a resident of Hong Kong, received payments from Indian bank towards provision of data processing support. Tribunal observed these infrastructure facilities they provided by the assessee to ensure quality standard. There was no use of equipment in this case again to qualify as a software payment. So, with this, we will move to the topic of fee for technical service, which is very, very important because normally, a lot of questions arises like if I, as a non-resident, is providing these services, if it's not royalty, whether it can be considered as a service. Like the example we just took, car. Okay, it's not royalty, but whether I'm giving that services, it can be taxable as FTS. So, one to the royalty provisions, this FTS is also taxed as per deemed sale, source rule. I'll not discuss this slide again because it's absolutely similar to royalty. If it's paid by a government or it's paid by a resident or paid by a non-resident to non-resident person in respect of services in India. Yeah, so moving this now to FTS. See, the term FTS has been defined under the Income Tax Act as per explanation 22 section 917. What is FTS? It is consideration payable for rendering of managerial, technical, or consultancy services. So it includes provision of services of technical or other personnel, but it excludes consideration for construction, assembly, mining project. Now, the question arises if the foreign company is providing services, managerial, technical, or consultancy services. So, under the Act, the ambit is very, very wide that it may qualify as taxable as fee for technical service. It's also important to understand these terms managerial, technical, consultancy, which we will be doing in the next slide. But before that, on the right hand side, what it says about a typical DTA is see, a service may be a managerial, technical, or consultancy service simply because it is any of these kind of service doesn't make it as a taxable service under the treaty. There is an additional condition which needs to be satisfied. In some of the treaties like UK, US, Singapore, the services make available the technical knowledge, experience, skill, know-how, or the services are ancillary and subsidiary to the application or enjoyment of right. We will discuss this in greater detail. See, the point is, आपके डोमेस्टिक एक्ट में तो डेफिनेशन बहुत वाइड है, लेकिन अगर एक नॉन रेजिडेंट है जिसको ट्रीटी का बेनिफिट मिल रहा है, तो यू मे बी प्रोटेक्टेड अंडर द ट्रीटी एंड द सेम पेमेंट्स मे नॉट बी टैक्स्ड एज एफटीएस, बिकॉज ट्रीटी से सिर्फ एक टेक्निकल सर्विस होने से वो टैक्सेबल नहीं हो जाती. यू हैव टू मेक अवेलेबल द टेक्निकल नॉलेज टू द अदर पर्सन. लेट्स से आप मुझे एक सर्विस दे रहे हैं, आप सीए हैं, आप मुझे सर्विस दे रहे हैं, एक प्रोफेशनल सर्विस. ठीक है, मुझे ओपिनियन चाहिए था, आपने दे दिया, अपनी कंसल्टेंसी सर्विस दे दी, बट दैट डजंट मीन्स सपोजिंग आई एम अ क्लाइंट, आप मुझे सर्विस दे रहे हैं, मैं तो उसको आगे अप्लाई नहीं कर सकती ना. आई हैव नॉट गेन्ड नॉलेज ऑन दैट टेक्निकल सर्विस. अब मेरा क्लाइंट है, वो मुझे कहता है कि आज आप मुझे बताइए कि मेरी पी बनेगी कि नहीं बनेगी, ये मेरी एफटीएस टैक्स होगी कि नहीं होगी. अब उसको जब जब ओपिनियन चाहिए, he'll come to me. So I have not equipped the person that made available the technical service to the person. In future he will apply and write the opinions himself. That's the difference. So in the next slide we will talk about what these managerial services etc means. See, these terms are not defined in the act, but there are plethora of judgments, and these terms need to be interpreted in a commercial sense and also basis the principles emerging from the judicial precedents. मैनेजीरियल इज नॉर्मली कंट्रोलिंग, डायरेक्टिंग, एडमिनिस्ट। हम मैनेज करते हैं ना किसी को, तो एक तो ह्यूमन एलिमेंट जरूर आता है। आप किसी को मैनेज करेंगे, कंट्रोल करेंगे, नहीं ऐसे नहीं ऐसे करना है, ensuring all the things are going, as it needs to be managed. Then when we talk about consulting, it's a person who gives a professional advice, specialist field. It could involve deliberations, consideration, conferring with someone, ask advice. Expertise in technology is not essential. आपने मुझे बोला कि एक कंसल्टेंसी चाहिए, I'll give you consultancy. It may not be necessarily in the field of technology. तो कंसल्टिंग में टेक्नोलॉजी नहीं है। जब हम टेक्निकल सर्विस की बात करते हैं, टेक्निकल सर्विस में आपकी टेक्नोलॉजी का एलिमेंट होना बहुत जरूरी है, एज इट टॉक्स अबाउट इन्वॉल्विंग और कंसर्निंग अप्लाइड एंड इंडस्ट्रियल साइंस। एन इंपॉर्टेंट थिंग हियर इज, आप देखेंगे मैनेजीरियल और कंसल्टेंसी में एक ह्यूमन एलिमेंट है। टेक्निकल सर्विस में देयर मे नॉट बी ह्यूमन एलिमेंट, इट मे बी अ फुली ऑटोमेटेड सर्विस विच कैन बी प्रोवाइडेड। So again, there are a lot of questions कि वो कैसे taxable होगी. So let's see that at the next slide, which is provision of a standard facility, what we call. Standard facility की वही example है. There could be 2-3 examples. One is the car. Anybody has to travel from place A to A. जिसको चाहिए वो गाड़ी में बैठा चला गया. Let's say I have to make a call. Again, there is a judgment of the Karnataka High Court, also recent judgment on this interconnectivity. हम कॉल करते हैं, अब वो कॉल कनेक्ट हो रही है, मैं आपको कॉल कर पा रही हूँ, इट कुड बी एन ओवरसीज कॉल। भाई इंडिया का जो नेटवर्क है, इंटरकनेक्ट चार्जेस दैट मे बी टू अ पर्टिकुलर पोर्ट। नाउ देयर आर वेरियस टेलीकॉम ऑपरेटर्स विच टाई, आई हैव टू मेक अ कॉल टू दुबई, सो देयर विल बी डिफरेंट टेलीकॉम ऑपरेटर्स इन्वॉल्व। तो क्वेश्चन आता है कि क्या जो ये नॉन रेजिडेंट इनकम अर्न कर रहा है in respect of the services which is provided, whether it qualifies to be a fee for technical service. अब आपका ये टेक्नोलॉजी तो है, इसमें तो बहुत सोफिस्टिकेटेड टेलीकॉम इक्विपमेंट्स यूज्ड हैं, टार है, इतनी टेक्नोलॉजी है, कॉल फ्रैक्शन ऑफ अ सेकंड में अपने आप हो जाती है, तो क्यों ये टेक्निकल सर्विस? इफ दिस इज नॉट टेक्निकल देन व्हाट इज टेक्निकल? बट द आंसर इज दिस इज नॉट टेक्निकल सर्विस. We'll explain why. See, one is now the word technical, as we were seeing earlier, it is sandwiched between the words managerial and consultancy. So one of the interpretations is because it is sandwiched between that word, it should derive the meaning also from that words. Managerial में human intervention था, consultancy में मुझे किसी को advice देनी है तो there is a human intervention. Then even for technical service there has to be a human intervention. If there is no human intervention, it's a fully automated service, then one can say, it is not taxable as FTS. There's a Supreme Court judgment, Bharti Cellular, which has laid a lot of focus and explained, on the importance of the human element. But here, one thing very important which I would like to mention is there's another judgment of the Supreme Court again, Kotak Securities, which says most of these services, today they may be fully automated. There may not be any human involvement. So, but it has laid down very important parameters that when a service can be said to be a standard facility, and when it's a standard facility provided to anyone who wishes to avail that service, will not be taxable as FTS. He says if the service is something which is very, special, exclusive to the seeker of service. आपने मुझसे कोई सर्विस मांगी, अब मैं आपको वो सर्विस दूंगी which will be specific, which will be customized as per your requirements. As against an example, मेरे को फोन की सर्विस, वोडाफोन, all these are providing services, but these services is not specific to me, it's not customized. आपको फोन करना है, मुझे फोन करना है, किसी को भी फोन करना है, सबके लिए सर्विस सेम है. We will pay the charges, monthly plan, we will, pay it, and the non-resident will get a service fee for providing these services. But this is a standard service which is not taxable as FTS, which is a very, very important criteria here and practically applied. And again, as the slide says, the word technical we have covered, it is more sandwiched between managerial. It has to be construed as involving direct human element. It should not be a common facility. Every provider of a facility cannot be regarded as providing technical services. Service should be specialized, exclusive, customized service according to the requirement of the customer. Very important. Recent interconnect charges, there was a lot of controversy. A lot of telecom players had received notices whether these payments are taxable. The High Court has ruled that these payments are not taxable as FTS services, which is again a very, very welcome judgment. So, with the next slide, again, same principles emerging is this we have dealt. We'll go to the next topic. These are the same principles we have already talked about. Make available, we'll discuss. So, see, make available concept, as we discussed, some treaties have a restrictive definition like US, UK, Singapore, Netherlands, Cyprus that make available. How do you read this word make available? It is not defined in the treaties, but in the Indo US treaty, there is a memorandum of understanding which helps explain the term what is make available, and it gives a lot of examples like whether question form, whether this will be make available or this will not be. So what it says is the person acquiring the service is able to apply the technology. The use of a product which embodies technology cannot be considered to make technology. As we took an example of car, technology तो है, कोई service available है और या professional मैंने service दी but I'm not making the service available to the other person, and several other principles by way of examples in the MOU. So the important tests here are, see, test one is if I supply, I transfer the technology or the technical knowledge to the other person. The relevant test to the person P2 to whom the knowledge is supplied, he is able to apply that technology. The services should have something technical knowledge, which is important. And P2 is able to make use of the knowledge skill by himself in his business. Knowledge must remain with P2 once service has ended. Some sort of durability or permanency of the result should be there. And P2 is at liberty to use the technical knowledge. Same example, मैंने opinion दिया, but मैंने आपको सब बता दिया कि कैसे है इसमें टेक्निकलिटी ये है, आगे से आप खुद बना सकते हैं. Those cases, आपने किसी को टेक्नोलॉजी दे दी, ये मैन्युफैक्चरिंग होनी है, दिस आइसक्रीम बनी है, you mix this and this, you will get this. You give that knowledge. That will be a make available and hence taxable, but not the other way around. Again, you will find that there are some treaties in which there is no FTS clause. The question arises what happens in those cases when FTS clause is missing, and also in the royalty clause definition, there is no FTS clauses. Then, how this income is to be taxed? There are various treaties, for example, UAE, Saudi Arabia, Bangladesh, Nepal, etc., what is listed on the slide. FTS clauses not there. अब इस पे ना बहुत different views चलते हैं. Some people says नहीं है तो फिर ठीक है, taxable नहीं है. अगर FTS में two countries have negotiated the tax treaties, they have decided FTS clause to be not there, तो intentionally नहीं है ना, तो it should not be taxed. So let's see what are the three views prevailing here. The first is if income is earned by rendering services in the ordinary course of business, such income would remain under Article 7. Article 22, which deals with residual income, is not covered in the earlier slides. So, see, Article 7 आपका generally business profits का है. अब I said, okay, मैंने किसी को as a non-resident services दी. It's a business income for me. So, anyways, it's there under Article 7. So normally there are three articles. Article 7, then we have Article 11, 12 talking about FTS, and there is other income residuary clause. Let's say residuary clause है आपका Article 22 में, but आप कहते हैं the one view is when FTS clause is not there, it's my business income. I do not have a P in India, so this income will not be taxable. Why do I go to other income clause and see whether the income is taxable under the residuary clause? It's my business income, no P, no taxation. The second view here is no, because there is no separate specific article of royalty FTS, and if there is other income clause, so you go to that clause, see what it provides. If it states it's taxable, then it has to be taxed. If it states it's not taxable, then fine, but go and see the other income clause. Then, there are other sort of treaties which will not have FTS clause and even will not have the other income clause. So now one position is okay, it's my business profit. Article 7, no P, no taxation. But another view basis certain judgments is simply because FTS is not clauses there in the treaty or other income is not there, you have to go back to the domestic tax laws of India and tax the income at the rate of 40% there of the non-resident. If it's FTS, even though the article of FTS is missing, the article of other income is missing. So it's very important, there are a couple of precedents here, and mainly these three views are there which are prevailing. So with this, we'll move to the next slide. This is again a very, very important change. I'm mindful of the time. I'll quickly conclude the slides. So one is amendment in the rate of royalty and FTS. The rate has been increased from 10% to 20%. See, in the prior years, many companies used to say, okay, the treaty rate is 10%, but the domestic rate is also 10 plus surcharge says. But then if the tax is deducted under the domestic tax law, I don't have to do any compliances. So I don't wish to avail for the treaty. Many people used to go for the domestic tax law provisions also. But now it's a huge cash flow issue, where the rate under the domestic tax law has been increased from 10 to 20. And the rate, let's say, under the treaty is 10%, then obviously the non-resident companies would like to avail the treaty benefit, and hence it becomes important to analyze the availability of DTA benefit in terms of, again, the same principles what we discussed in the initial slides, like tax residence, PPT test, any limitation of benefit clauses, etc. And one also has to be mindful of the other compliances which needs to be undertaken by the foreign company when availing the treaty rate: filing of return, obtaining of PAN, TRC, 10F, transfer pricing study in case of related party transactions, no P declaration, etc. Moving next is, it's important, this royalty, FTS, and equalization levy. So again, equalization levy is a new thing which has come up. The EL2, the 2% tax rate. Um, just very briefly here, see, if the transaction is taxable as royalty FTS, then under the Act, okay, it will be taxable as whatever 20, or under the treaty at 10%. But one will also have to see, like, if the payment doesn't qualify as royalty FTS, then one should examine whether equalization levy provisions are applicable. If yes, then 2% tax is applicable. And if EL is applicable, then this income is exempt under the provisions of Section 1050 under the Income Tax Act. And this right side is same. Other transactions which are subject to EL, no treaty benefit, they will be taxable. Obviously, for equalization levy, there is no credit of taxes, etc. So it's important to see when a foreign company is providing the service, first see whether it's FTS, royalty. If it is not, whether equalization levy is applicable. Okay, if EL is applicable, then EL returns to be filed. Okay, exemption is there under Section 1050. So all these things needs to be taken. Okay. Next concept, again important, is receipt is accrual of income. See, in these passive type of incomes, it becomes important to see. See, you will see the treaty language, it uses the word paid. For example, it says interest arising in one of these states and paid to a resident of the state may be taxed in other state. Normally, we see, accrual basis taxation. But the treaties in respect of these passive income provides for a paid actual receipt basis taxation and not accrual basis. So practically, you may come across certain circumstances where there may be accrual, but there's a bad debt. The person may not have received income. So there are couple of case laws also of different tribunal and high courts which clarifies this position, that a position can be taken, income in respect of these payments is to be taxed only on receipt basis and not on accrual basis. So if I have not received the income, though accrue, they may not be taxed. I may defer it to the next year also. Okay, this will briefly cover, and then we'll take the next, question answers. So, most favored nation clause, the recent Supreme Court judgment in the case of Nestle, uh, recent judgment and the much discussed judgment. See, I'll briefly explain what was the issue, what the Supreme Court has held here is. See, normally we see like India has entered into DTA with the countries, right? Regarding what should be the scope of income, what should be the taxability rate, etc. Subsequently, India may enter into a protocol which is there at the end of the treaty or the most favored nation clause, and it may provide that if India, post the entering of the DTA or the protocol with that country, enters into a DTA with another country, and that other country provides a rate or a scope more restricted, and it's an OECD country, then even for the first country the rate will be lower or restricted rate. Let me give this in simple terms. आपकी एक ट्रीटी है नीदरलैंड्स की, वो कहती है आपका डिविडेंड्स पे 10% टैक्सेबिलिटी है. देन इट सेज देयर इज अ MFN क्लॉज, वो कहता है कि आपका रेट अगर इंडिया किसी और कंट्री OECD कंट्री के साथ DTA एंटर कर लेती है और उसमें अगर रेट 5% है डिविडेंड्स का, तो नीदरलैंड्स को भी 5% टैक्स रेट मिल जाएगा. दैट बेनिफिट विल बी एलिजिबल. सो ऑलवेज इट हैड बीन इंटरप्रेटेड इन अ वे कि अब आपके पहले ट्रीटी एंटर हो गई 10, बट सब्सिक्वेंटली कुछ ट्रीटीज एंटर हुई विच वर द फैक्ट्स इन दिस केस. लाइक इन दिस केस लॉ देयर वर नीदरलैंड्स, फ्रांस एंड स्विट्जरलैंड वर द कंट्रीज. एंड देन इसके बाद जो ट्रीटीज एंटर हुई थी एट अ लोअर रेट ऑफ टैक्सेशन वॉज स्लोवेनिया, लुथेनिया, कोलंबिया. सो मेनी टैक्स पेयर्स सेड डिविडेंड पे हम तो 5% टैक्स ऑफर करेंगे इंस्टेड ऑफ 10% in the original treaty to invoke this. So, what the Supreme Court has held in this is a very remarkable judgment. It has held there is no automatic integration of beneficial treatment granted to the third state. Separate notification to be issued by Indian government to bring in the MFN clause. मीन्स कि ऐसा नहीं है सेपरेट ट्रीटी कंट्री एंटर हो गया मुझे भी बेनिफिट मिल जाएगा. वी से अरे MFN इज आल्सो पार्ट ऑफ द ट्रीटी ओनली, तो मिल जाना चाहिए. दे से नो नो, दे से अ नोटिफिकेशन अंडर सेक्शन 90 is a necessary, it's a mandatory condition to give effect to a DTA or any protocol that has the effect of altering the existing provisions of the law. So separate notification अगर Indian government issue करती है then you will be able to eligible this rate, otherwise not. And in this specific, because there was another controversy in this judgment, which I'll not go in detail, the countries like Lithuania, etc., whether they were OECD member on the date they entered into the treaty. So this was again one of the technical issues. They said जब उनके साथ treaty enter हुई थी उस दिन वो OECD member countries नहीं थे. They became OECD member countries at a later period of time. So this, like Netherlands, etc., cannot avail the beneficial tax rate of 5% considering those judgments. Now, this impact of apex ruling is very important, like for dividends, which is paid to, let's say, Netherlands shareholders. The argument, a 5% tax rate as against 10 is all now gone for a toss, etc. So, this is a recent judgment, which is there and which is helpful. So before we open for questions, Mahima, who was displaying, I would really like to thank her. She's my colleague. And, she has really helped me in preparing this presentation, putting the slides together. So special thanks to Mahima. Thank you. Thank you.
Thank you, Geetika. And now I request any participant have any question, you can ask me. Sachinji, you can see if there are any.
Yeah, there are a couple of questions in the chat box. So maybe what I can see is, so in case of copyrighted content by Himanshu Jain, if sale of goods, there should be no withholding tax. Yes, Himanshu, that's right. If it's a pure sale, like a good, a copyrighted article, then as the position by engineering analysis is there, where it is not taxable, one can take a position. Yes, there should not be withholding tax also. By Rahul Pareva, there is a question, make available clauses not there in every treaty. That's right. There are certain treaties which provides for make available clause like UK, Cyprus, US, Netherlands, Switzerland. All treaties do not have a clause. Some are similar, like the domestic tax law. The definition is wide enough, like Denmark, etc. Dipali Garg, same question. Yes, not available. She has answered this question. Thanks, Dipali. That yes, it's not available in certain treaties like Thailand Treaty. There's another question by Megha. Is TDS applicable on recharge invoices raised by foreign affiliate to Indian entity in respect of license fee paid on its behalf? So, Megha, I'll try to answer this question. If the question is something else, please feel free to ask. So, I believe the question is more if it's a pure reimbursement of an invoice on behalf of the foreign company, whether it will be subject to withholding tax. See, one can obviously take a position. There are judgments that when it's a pure reimbursement of expenditure, backed by appropriate invoices, like foreign company has availed these services, let's say 100 rupees. I am just making a payment to the vendor and then I'm cross charging from the foreign company. Yeah, cost to cost reimbursements, one can say that it is not taxable. But it's always good to have more arguments. It is not FTS just on the uh, this cost to cost reimbursement. Then by Vipin Gupta, there's a question: in case of technical or consulting service provided by a US based company, it has provided all doc like 10F, etc. No P. Income tax rate should be applied, or the Indian company has to pay without withholding. So, Vipinji, again, UA is the treaty in which no FTS clause is there. It is important to look at other income clause. It could be controversial if a position is taken, it is not at all taxable. But, again, there are judgments which support this view also. Obviously, it may involve litigation, but that's, again, supported by judgments to hold in the absence of the FTS clause. Should not be taxable, and specifically it's a stronger view where the other income article also provides that it should not be taxable in the source country. What are the consequences of getting form 10F without PAN through online mode? Whether need to file income tax. See, 10F, recently a lot of changes have happened. Earlier, only you had a PAN, you can upload 10F. Now there is the window available on the portal, even if you don't have a PAN in specified circumstances. Form 10F could be there. Whether to file or not to file income tax return, it's the obligation is what is the nature of the income, whether it's taxable, whether you are claiming treaty provisions. If you are claiming treaty provisions, yes, it is mandatory to file the return of income. There's another question by Umesh. If any person have US citizenship and providing consultancy service live in India around 10 months from Feb 24, whether need to deduct tax at DTA or ITNA. See, we have to see the concept of resident one for availing the tax treaty and not a citizenship concept. If the person qualifies as a resident of a country and under that treaty, it satisfies the condition of a lower rate, then the treaty provisions can be availed of. Um, there's a question: in a single contract where we have two price schedules, one very, very important question, one for supply and another for service and installation. Supply is done from India. Sorry, supply invoices done from India, services from P branch. Whether income from supply of India can be. See, basically, the concept of supply service installation, the concept is this: if the service, if let's say the supply of equipment is from outside India, it's like if the title of the property has transferred out of India, one can take a position it is not taxable. But what litigation in usually, these cases like the Motorola case, the landmark judgment, special bench, a lot of other judgments, the controversy is there, equipment is supplied outside India. But when the installation is happening in India, one has to see whether it's an integrated contract, how the split of the pricing has been done, what is the role of the foreign company in doing this installation, etc. So if it's a pure case that supply is from outside India, installation is there, one can prove it's a separate contract, consideration is separate. The installation, because of the installation, the supply contract will not get repudiated. Even if installation, let's say there's a fault, then supply is not taxable. But again, lot of judgments. It's a very fact based thing. One has to review how the agreements are worded, what are the facts in the case. But if supply of equipment the title is transferred outside India, yes, the same is not taxable. Um, I think I think all questions are taken. If there are any other questions, please let know. I think we have tried to cover all the questions.
Thank you, Geetika ma'am, for your nice deliberation on the topic.
Thank you. Thanks, Dipali. Thanks, everyone. And thank you all, wonderful audience, and for giving the opportunity to present in this session. Thank you so much.
Thank you, Deepali ma'am,
Thank
for
you.
your wonderful
Thank you.
delivery. Thank you. Thank you, Geetika. Sorry.
Thank you, Geetika ma'am. Thank you. Thank you so much.
Thank you so
Thank you,
much.
Satanji. Thanks, Sumitji.
Thank you.
Okay.
Okay.
Thanks.
So, please close the meeting.